Commercial construction on the brink, manufacturing to the rescue, or so we thought. We've been paying special attention to the construction spending figures lately as they tend to give us some pretty interesting insight into the various sectors of the economy. Today's report did not disappoint. We're going to show you exactly where construction spending gives us the most hope as well as the most amount of fear. We're going to see why the manufacturing numbers in particular can be so deceiving and why construction spending can serve as an effective leading indicator. The construction spending figures are broken down into several categories. On a month-over-month basis, overall construction spending was down 0.2% for the first time since December of 22. But more notably, declines were found in the commercial sector at a pace of 3.1%. We're going to tell you why this number is actually worse than it seems. On a brighter note, the manufacturing sector rose this month by 2.1%. But as always, considering this data on a year-over-year basis, we can gain a better understanding of the true strength or weakness within the construction spending sector. On an annual basis, total construction spending was up 12%. With this report, commercial spending only rose 3% for the year, barely hanging on to positive territory. But with a 37% increase, manufacturing is here to the rescue, or so we thought. You're going to see this news might not actually be so good. Overall construction spending enjoyed a steady rise over the past year, with the latest report showing the first decline in quite a while. With 12% year-over-year growth, construction spending has reverted to levels we haven't seen since October of 23. Commercial sector spending continues to establish lower lows for nearly 2 years now. The current 3.2% annual return is the second worst of the year, giving little hope for the near-term future. If you recall, on a year-over-year basis, most components of the construction spending rose. In particular, the manufacturing sector increased by 37% this year. On the surface, this certainly looks like a good number. But overall, the manufacturing slice of construction spending is actually in a bit of trouble. Today's 37% release marks a significant drop from the prior 65% reading and actually a very troubling turn of events. The weakening in manufacturing is further confirmed with a complementary data set. Industrial production, a commonly used gauge of manufacturing, has also continued to decline over the course of the past few years. The following chart gives us a long-term view of the different components within construction spending. In particular, note the manufacturing shown here in yellow has recently achieved a significant high, but is now on the fast track to the downside. Going back in time, the manufacturing segment of construction spending also achieved impressive highs in mid-2008, but then, in dramatic fashion, fell into the depths of the financial crisis that ensued. It is important to note the similarity in declines between 2008 and present date. As Mark Twain famously said, history doesn't repeat itself, but it rhymes. Shown here in blue, we can see the total construction spending alongside the S&P Case-Shiller Home Price Index in white. Interesting to note, construction spending rocketed higher in 2019. The Case-Shiller Home Price Index followed suit, but around a year later. This suggests construction spending conducted today can translate into growth in the housing market down the road. At the moment, the year-over-year gains in construction spending certainly gives us reason for hope. For this reason and many others, we're going to keep an eye on construction spending for clues about the future of our economy and housing market. So, taking all this into consideration, what does this all mean? We've spoken about the disappointing construction spending and a surprise drop in manufacturing. Does this mean the Fed is about to cut rates? Not necessarily. We recently discussed some of the reasons why the Fed may actually be pretty far away from cutting rates, and their hesitancy may actually be taken as an optimism sign. It's a pretty interesting take on the Fed and the Monetary Policy Balancing Act. We'll provide you a link for that video right here. Next week, we have some pretty important economic reports as well. Wholesale inventories and the very crucial non-farm payroll report. So be sure to keep an eye out for that in our updates. We thank you for joining us. We look forward to seeing you back soon.